Sentiment's awful, which is exactly why I think it's an interesting opportunity. Sentiment, whether it's in Europe or the US, on commercial real estate is pretty negative. And as an investor, we find that attractive. I mean, it can't be that every piece of commercial real estate in Europe, for example, is a poor investment. But the sentiment feels like that. So we think it's an interesting area to explore.
Do you have preferences for certain markets or certain regions when we talk about commercial real estate? Because Europe is such a vast, not one market is the same as the other one.
And we have investments in commercial real estate from the UK to Germany to the Benelux countries. So we're kind of all over, less so in Southern Europe, not because we don't think there are opportunities, but we just haven't really focused intently on that yet.
Another big topic I've been discussing with other players in the markets is warehouses and the whole digital infrastructure thing. Is that something you're looking at as well?
It is, but it's also a function of price. So digital data warehouses, everyone is excited about that. That's reflected in the price. So you have to make sure that the price reflects the value and also the amount of capital that's required to build out digital, for example, is enormous. So to the extent there are mistakes, they will not be small because there's so much capital going in there. But we think it's a function of price.
Let's also look at the United States, because clearly the commercial real estate market there is very, very big. Is that the same assessment, that it's attractive?
We think so.
Yeah.
We think so. You have to remember, a lot of real estate lending in the United States is driven by smaller banks, regional banks. And what's happening to those banks right now, they already have a lot of real estate exposure. And I would imagine regulators are looking at that and have to increase their capital bases, their equity capital. As a result, there isn't, we think, a lot of new capital formation in real estate lending in the U.S., again, which we think is pretty interesting.
That brings me to the next big topic, which is private credit, of course, which you are focusing as well. So there's a lot of money pouring into that market. Is that also a sign of concern? Because, of course, the more money, the more competition, and perhaps the more risk you would take on?
I mean, look, what happens with any asset class when money comes in, investors feel compelled to put it to work. And when there's so much money and everyone is competing, what happens to the economics of that business? It compresses. So you see what's happening to credit spreads in the direct lending world. Even over the past 3 or 4 months, they are contracting quickly, and we think that's just a function of the volume of capital coming in. It's also interesting to watch this dynamic between large private credit lenders versus traditional banks, both here in Europe as well as the US. And there's a competitive aspect to it. But we think that some banks are trying to think forward, and perhaps rather than competing with private credit lenders, maybe they should be working with them. We think that's an idea that is quite ripe.
How do you do that in Europe? Because clearly banks in Europe are so much more dominant than in the United States. How do you make access to interesting clients?
Well, I mean, you actually said it. The banks in Europe have these long-standing client relationships, for years, sometimes decades. It's very hard for a private credit lender to generate those types of relationships. It is relationship banking. And the trick is you have to marry those relationships that are the province of the banks with capital providers such as direct lenders. In Europe, it could be even a little more challenging because there are many different markets. So a dominant bank in the UK, for example, is likely to be different than a dominant bank here in Germany. So you have to establish multiple partnerships. So we'll see what happens there.